So if you're just joining us, we want to welcome you every month at Factum. We have the opportunity to have a couple of education offers, excuse me. We have an infinite banking mastery conversation with advanced topics for our clients, for our community. And if you're new to the community, we invite you to this foundations class where we go through some basics. We have some of the pros here in the room, part of our wealth strategists. And why don't we just jump in and get started? If you don't mind giving me a thumbs up, gentlemen, or Cheryl, that you can see my screen, that would be really kind of all of you. Perfect. Let's jump right in, and I want to make sure I have the chat and things pulled up here. Perfect. Thank you, Shala, for being here. I appreciate you. So, like I said, I'm joining you from Phoenix. Our team is headquartered here, but we have agents and wealth strategists across the country. We're a nationwide agency. We have clients in Alaska, Hawaii, all the way to Maine and Florida. And we bring to all of them, to start in this conversation, an idea that expresses the values and the way we see the role that our expertise plays in people's lives more broadly. This idea you have in front of you seems like a simple gray circle with different areas. We call this the 5 areas of life. And the premise we want to put in front of you is that to live an ideal life, we must have abundance in all the key areas of your life. For us, it's 5 key areas: spiritual, personal, family, financial, and occupation. You may have a 6th one or a 7th one, or perhaps only 4. But nonetheless, the point of putting this in front of you is that the reason a lot of the members of our team, most of our team actually, is obsessed with helping you get healthy in your financial life, to express abundance in your relationship with money, is because ultimately we believe that's the area that allows you to fund the activities and the things you need to express yourself fully in the other parts of your life, with your children, with yourself, your mental health, with your God, with your spirituality, with the people that you want to bless beyond your physical presence, with your business, your community. And that's why I want to say to all of you to start, thank you for being here. We're very grateful that you take the time in Tuesday afternoon at 5 p.m. or 6 p.m. if you are in a different time zone, or 7 even on the East Coast, to come and get some education and deepen your thinking about this. So that is the idea to start. And I want to tell you also, we're going to be talking about 3 main key points for the entire conversation. Likely we're going to take 45, 50 minutes. I love to have some time at the end for questions. I promise you questions will come up. This is an idea that requires exposure, that requires some education, and this is not going to be the last thing. So for all of you that are new to this presentation, I encourage you, as a takeaway from the beginning, to put in your notes, to reach out to the person that invited you, to deepen the conversation, to ask for some additional resources, because behind what I'm about to talk about here for 45 minutes, there's a library of 14 courses, 30 hours of content, workbooks, live events, and I think a wealth of knowledge that you will certainly appreciate and benefit from if you pursue it further. So the 3 ideas that we're going to talk about in the agenda for today are: we need to become aware of the problem. What are we solving for? What is the problem that all of us actually are dealing with, but we may not be able to have the language or the framework to label it, to understand it? I call this with my kids, we need to name the monster in the closet so we can understand that it's not real, or we can do something about it. We're going to talk about the problem. Number 2, we're going to talk about the toughest asset. We're going to talk about life insurance, and particularly whole life insurance. Regardless of your relationship, your perception, whether you own it, whether you will never own it, my promise to you is that we're going to position it and present it to you in a way that you've never likely looked at it, and it's going to at least give you curiosity to understand further why so many people use this as a very important asset in their balance sheet. Number 1 player in that game, the banks. So very wealthy individuals are using this asset. Maybe there's an argument for us, real people, the you and me, to learn more about why, and maybe understand whether it would be beneficial for our lives. And the 3rd idea would be this reassuring lie and the inconvenient truth. This is an idea that invites you all to get on your workout clothes, Cheryl, and show up to the gym and do some cleans and jerks and get stronger, because nobody's coming. When it comes to the relationship with money, nobody's coming. And we need to do the workouts and get stronger and understand how to manage this in a serious form. By the way, the workout this morning killed me. So I love when I saw your name and reminded me that at least I show up, and we are here to show up for that. Okay, let's jump into idea number 1. The problem. So if you've never read this book or you are not familiar with this book, this is the seminal book that describes the idea of the infinite banking concept by Mr. Nelson Nash. This book has a very clear definition of what the problem is. And I want to deepen that definition with you today so you at least leave the call understanding and having the awareness of what may be the problem with your relationship with money. In the book, he says, you finance everything in life. You either borrow money and you pay interest. I go to a bank and I take a loan. I'm going to pay principal and interest. All of us are very, very clear that that is the reality with a credit card, with a mortgage, with an auto loan, right? We pay principal and interest. And when we don't like paying that interest, we move to the other side of the pendulum. What if we use cash? And he says, when you pay cash, you give up the opportunity to earn interest. Earn interest. The problem is that we finance everything in life through other banking organizations. Call it Chase, Wells Fargo, a local bank, a credit union. Other people's reservoir of money are financing our purchases and our lifestyle. And that has an opportunity cost. So the part here that is difficult to understand is that all of us have an opportunity cost, have a loss every time that either we borrow money and pay interest, or when we have the patience to accumulate our own savings and we use that cash, we interrupt the ability for that money to continue to grow in the next 5, 10, 20, the rest of your life. It's very costly. As a matter of fact, I brought this here to put it in a little calculator. This is a future value calculator, and I'm not going to go through the whole experiment here because the trick here in this experiment is to tell people, hey, if you make $100,000 a year and you become a really great saver and you save 30% of your income, $30,000, what would it look like if you put that money to earn 4% for the next 30 years? How much money would you have in the next 30 years? And you all can see that the answer is $97,000. Any of you shocked by that number? Nobody? Okay, just me. I can tell you, the number is not the takeaway that I think about when I think about that experiment. And this is after doing this hundreds of times across the country. The takeaway is this. Most people never get to that $97,000 because this equation of compounding money is not linear. It's very difficult to think about. It's exponential. And we have, as humans, a hard time understanding the potential of our savings and our money when we put them in the right places to compound at the right rates. So when you pay in cash, every time you make a decision of $10,000, $5,000, the next vehicle, the next home purchase, the next investment, the awareness we need to have is that the problem is that those cash purchases or those credit purchases have an opportunity cost to our wealth. Now, I'm going to let a few more folks here that just join us, but I like to deepen that conversation with a very real example for all of us. So what you see here now in the screen is, I don't know if you're familiar with Mr. Robert Kiyosaki. He is the author of Rich Dad, Poor Dad. He also has this book that came after it called The Cash Flow Quadrant. And in the book, he talks about the different roles you can play in the economy: the employee, the self-employed, business owner, and investor. And if you read the book, you know that the premise of the book is that moving to the right of this quadrant is very beneficial because we play in different roles with different tax positions with different leverage. And he's not wrong. But the part that we never ask is, who's playing the role of the banker in this quadrant economy that he plays there? And I can tell you, when we all realize that the banker is everywhere, is where the employee deposits the paychecks, how they take a credit card, how the self-employed saves for payroll or accumulates FICA taxes. The business banker has to pay their employees, use lines of credit. The investor is using when the banker is embedded in all places of the economy, the thought that should come to our mind is this: what if in our personal economy, we already play the saver? From our income, we keep something. And also we interact with a bank to deposit those savings, but we also from that same entity borrow money in different fashions: a mortgage, an auto loan, all these things we've been discussing. We put our money in the banks and then we borrow some money from them. And then we have to repay that money with high interest rates when they give us very little interest on our money, on our savings. If you don't believe me, think about the fact that when we go to Chase, and if you've banked with one of the large bank or commercial banks, it doesn't have to be Chase, you'll know this is true. When you go and you realize that a mortgage at 3, 4, 5, 6, 7, 8%, credit card 20, 30%, a personal loan at 10% plus. All these are higher interest rates than our checking accounts are receiving. When you have a checking account at Chase, you're getting paid at 0.05%. The bank is benefiting from those spreads. And if we just think about, hey, what if I could create a closed economy by taking some of that role in my control, the banking function, we will then move into this paradigm of why so many think about the control of money being the conversation we need to have to enhance our ability to have a better relationship with money. So I'll give you a perfect example of what we're talking about here. You'll notice here, this is from Nelson's book. He talks about the annual pattern of spending of the average American. Very simple categories. The typical major categories for the most Americans are they're going to spend 20% on auto or vehicles. They're going to have 30 to 35% in on housing, and then the rest is going to be lifestyle, 45%. And what's left here is savings. We first spend, and then whatever is left in the checking account, we call savings. And the paradigm here in traditional or typical financial planning is how do we put the highest rate of return possible to that 5% so we can save for the future, for future income. We never have the conversation, what is happening with that 95% that I'm sending away every month in autos, in housing, in lifestyle? To show you how meaningful this can be, let's take the example of autos, because this one is very applicable across the country. Most metropolitan cities in the country, we all have to drive, we all have to commute to work, to different places. So autos are a very common purchase for most Americans. If we just decided to say, hey, how could we effectively buy more autos? The conversation, 90% of the conversation will fall into these two categories. On the left, you see the saver is going to say, hey, I'm going to pay cash for this car for sure. I have no desire to pay the bank any interest. The borrowers will say, hey, I'm going to borrow the money. I'd rather use OPM, other people's money, than use my cash for this. So the question or the analysis should be, okay, what are the benefits? And if you have any benefits that come to mind, I encourage you to put them on the chat. I would love to hear your thoughts. I'll tell you some of the most common things I hear. The cash payer will say, hey, I don't want to pay interest. I had the discipline of accumulating some money over some time. I'm going to go ahead and pay with cash. Nothing wrong with that. I also don't want any payments moving forward. I just want to pay the car and own the car, right? I just want that to be my arrangement with the car. Perfect. The borrower will say, hey, I don't want to wait 12 months to accumulate this money. I need the car now. And I understand I'm going to pay interest. I don't mind. But I'd rather use other people's money and have those payments into the future. I'll be able to make those payments with future income. Nothing right or wrong about that. If you flip that analysis and you go to what are the costs, it kind of makes people sit back for a little bit. And if that's you, I encourage you to think about this. What is it costing me to choose one side or the other? And I'll tell you, borrowers, obviously, they'll tell you, absolutely, paying interest is painful. I'm going to buy a $30,000 car. I'm going to end up paying $35,000. I'm going to buy a $400,000 home. In the next 30 years, I'm going to pay $800,000 for that house. So that is a cost to borrowing money. What we hear from the saver is the following. I was not aware there was a cost of using my cash to pay for vehicles. I was not aware there's a cost. And the cost is in what would have been the alternative to keeping that cash and continuing to grow that money over the long term. The opportunity cost, the problem that Nelson's talking about. I'll ask you all one more question, which is this. And think about this in reality. How many cars you've ever purchased? Maybe you're in car 2, 3, 4, 5, right? Think about all the cars you've purchased. The question I have for you is how much money do you still have in your control out of all those purchases? How much money do you have still? If you've owned 4 cars like me in your lifetime, I can tell you I have $0 from car number 1, car number 2, car number 3. Paul McKell says 0, and he's bought probably 20 vehicles. So it's real when you buy a lot of cars. It's real when you buy a few cars, right? Why? Because the saver and the borrower, regardless of how in the short term they're financing this, paying either interest to a bank or using their cash and interrupting the growth of their money, at the end of the day, they're transferring money out of their life. And if you do this over and over and over as a borrower, you're going to pay interest and close that loan and take the next one and the next one and the next one. At the end of your life, you end up with $0 in your control. If you do the saver mechanism, you're going to save the money, buy the car, save the money, buy the car, but you end up with zero. This is a very significant reality. And I talk to people that are in their 20s, in their 50s, in their 70s, and it's a pretty stark reality that this has continued to happen in your life if you've never thought about controlling the banking function in your life, controlling the flow of dollars in your life. Mr. Brian Fleming says, look at both the saver and the borrower race to zero line. What sense is there in that? And Brian, you're right. But the reality is that we need to be aware of this because this, what we just described here, represents 90% of purchases of vehicles in the country. And we looked at it as a coin where there's one side or the other, but we need to start looking at the rich of that coin. Is there a third alternative, which is what we're going to talk about next year. So if you're saying, yes, David, how would we go about accounting or doing something different that can create a different result? I'll tell you. If you look at the average American will purchase 13 vehicles in their lifetime. Those purchases will amount, the calculation will amount to over $400,000 in vehicle payments, and they will end up with $0 in their control at the end of their lifetime. It's a pretty significant cost for the American annual pattern spending over a lifetime. But what if I told you that there's a way to make that same amount of purchases for $400,000 of 13 vehicles, but yet end up with $1.5 million in that accumulation of cash that represents the opportunity cost? $400,000 in payments over a lifetime that do not interrupt the growth of your savings can be the difference between $0 and $1.5 million. If you see this idea and this is new to you and you have never seen our content, I'm going to encourage you to make a second note and say, I need to ask the person that invited me to this webinar to send me the videos for how this process works for the purchase of vehicles. I need to see the math and I need to understand why David is saying this because it seems too good to be true. I'm just telling you, many people on this call do this on a daily basis and we've been doing it for years, for a decade, accumulating that opportunity cost to avoid the way that most Americans are doing this. So I think I highly encourage you to go and look at that content. You'll see all the math and the details. The wealth creator at the bottom, and I'll end with this. The ideal behavior here is to take the best parts of the saver and the borrower and apply them. We need our ability to compound our liquidity over time, over our lifetime. At the same time, we have the ability to have access to liquidity for us to continue to finance everything in life, like Nelson is talking about. How do we do this? We are going to have to talk about the toughest asset in history, which is whole life insurance, and we're going to have to talk more about the banking function itself. Just want to make sure, Cheryl says, own 2016 and Phil, and I will need a new car soon. Cheryl, I cannot encourage you more to please go and ask for that video and take a look because it's going to open your mind to a possibility that perhaps you've never considered before. So I'm glad that you're here. Thank you for sharing that. Okay, I'm going to expand on that. We talked about vehicles in the annual patterns of expanding. But if vehicles are not your thing and you're not a buyer of autos and not a significant portion, I can tell you the principle still remains the same. Banks, when they behave as the controllers of the banking functions, are taking deposits and they're putting velocity to money. All we need to do is replace the bank with an asset that allows us to control that flow of money, in our view, life insurance, whole life insurance in particular, to do the same thing that banks do. Every time we need to finance a home, right? We can borrow and finance the home, buy the home. And we can also do it with vehicles, and we can also do it with businesses or investments, or we can also do it to consolidate high interest debt. The actual finance asset or vehicle doesn't make the difference here. What it does is to be at the center, controlling that flow of money of the income we call savings, and how we deploy it to go finance the things we must purchase regardless. So that would be idea number one. And to recap, the problem here, like I was saying, is we finance everything in life. We either pay interest when we use debt, or we give up interest by interrupting the growth of our savings. If you have not considered this as a problem in your life, I can tell you it's ever present. My 2-year-old, my 4-year-old are dealing with the same problem that my father in his late 60s, that I am in my 40s, because we need to finance things in life every year, every decade. And it's going to be, it's happened up to this point. If you think about the vehicles example, is going to continue to happen. And it's a leadership conversation to decide that you want a different alternative for your life, for your family, for your business. Absolutely. So that's the problem. Now, let's get into that second portion, the toughest asset, which is probably the education that you came to find here in this webinar, which is the education around whole life insurance and why we talk so much about this asset, why so many of us are obsessed with this conversation, quite honestly. So we don't talk about good or bad in our framework. It's just a perspective, and we need to be fair to, for some folks, this may be very beneficial. For some others, it may not be. But if you go and survey people, your uncle, your neighbor, and you hear the common responses when it comes to whole life insurance, these are the 3 statements you'll hear. Low rate of return, expensive to own, the worst investment of all time. I'm going to ask you, please write this twice in your notes. If you leave this webinar just hearing one thing that I say is this: whole life insurance is not an investment. It is not an investment. I'm going to say it again. Whole life is not an investment. It's an insurance contract. The moment you think about it as an investment, you'll misunderstand it, misclassify it, you'll compare it to the wrong things. This is more equivalent to the safest, most liquid asset, most toughest asset you can use to store your savings, your liquidity. And we're going to talk about how to position that in your balance sheet. It is not an investment. As a matter of fact, if you want a model to do this, I will highly encourage you to also look at our Path of Money videos and the framework around this. If you don't have a mental picture on how money moves through your family or through your life, I'll give you a framework that may be useful in absence of one. This is, by the way, not necessarily a model that it was created. This comes from an idea from a billionaire. And the premise is this: when we work for money with active income, money comes into our lives. And money that comes in and goes out lives in your income statement. When money comes in, it becomes cash flow. And there's 4 things we can do with that money. Only 4. If you find a 5th one, you need to email me. But this guy with billions says only 4. You're going to be able to spend the money. So that's option number 1. You're going to be able to give it away or donate that money. Number 2, what's left after that we call savings. Savings has become a bad word in our country, and we need to bring it back with fear strength. Savings is important for the following reason. In order for us to move money and assets that we own and control into our balance sheet, you need your savings or somebody else's savings. So savings is a key element in this conversation to own and control assets. And when you move that to your balance sheet, you can do 2 other things. You either hold it as liquidity to protect your family or to take advantage of future opportunity, or you invest it, and hopefully you invest it to create more income so you can keep this growing your wealth and money flowing through your life. Simple model to say this: life insurance is not an investment. It lives here in your foundation, in this green box. All of us that are part of the Factum team that are on this call are specialists. We are an inch wide and a mile deep in this conversation. We are your defensive team, and we're going to help you play defense to the best you've ever thought of by putting the toughest asset in that foundational piece of your balance sheet. Some people call that a war chest. Some people call that a foundational asset. Whatever language you use, it is not an investment. It is where we accumulate and protect our liquidity. And just to say it one more time, life insurance, not an investment. Okay, so David, why would you do that? Why would some of you guys would talk about this? Let me give you an example, and I'm going to use an example from one of our partners, the CEO of Factum, Kyle Fuller. So we're going to pull an illustration and a real life insurance policy, but I want to give you a visual of how we're using this and why we call it the toughest asset. So we're going to go option 1, option 2. Option 1 is going to be what most Americans do in their normal process, and I'm going to contrast that to option 2, the use of whole life insurance to create that green box. So when most Americans are going to invest, let's say that they're buying a cash flow producing asset, a business, a real piece of real estate, they're going to make a loan. Typically, they need to look at their liquidity in their balance sheet before they can send that money to work. And they're going to go first accumulate the money in the bank, right? $50,000. And then in order to send that $50,000 to that investment, they need to draw it from that account. That account for a while is going to be empty, and the money is going to be out working in that loan or that property. And the idea is that that money over time comes back with more friends, more than $50,000, and we replenish that checking account or bank account of our liquidity. Every time we do this, that opportunity cost we've been talking about is present because we interrupt the potential of those savings to earn interest in our liquidity box. It was out invested, it was separated from us. And the reason we would then use option 2, life insurance, is because many of us in this call, what we would do is instead of keeping that $50,000 in a bank just plays the role of a transactional player. They're just helping us move money from one party to the other when we make these investments. Our money is really stored in what we call whole life insurance, a private contract that gives us a relationship with a mutual insurance company typically. When that $50,000 is stored there, that $50,000 is creating that wealth creator behavior. It's compounding daily, no interruptions. And because of their relationship with that mutual insurance company, it gives us the ability to access liquidity by borrowing against the equity in our contract. We're using it as collateral. We're not pulling money out. We're borrowing the insurance company money against, which means now we have an asset that is growing and we have the ability to go buy that property, to make that loan, to make that investment. Wealth behavior, wealth creator behavior. The other reason we do this is because our money stored in life insurance has a set of benefits that are very difficult to find in any other asset class. We're going to talk about that here in a second. The fact that it can compound daily, that it can have guarantees, liquidity, flexible loan provision, a death benefit. All these things are things that likely you will not have in other savings environments. And it's going to be a conversation of these environments trading with each other all the time. If you want a quick example of this, some of us keep money on a safe at home. Why? Because it's the most private money we'll ever have. Nobody knows we have it, right? But the problem is that when you open the safe, there's no additional dollars in there. It's not growing. It's not providing yield. So we may move some of that money to a bank. And in the bank, maybe there's a high yield savings account that is providing yield, but now it's not private. And we constantly make these decisions to try to get one benefit from the other in trading. The moment we move the conversation to whole life insurance, the trade-offs are over and we get a suite of benefits that maximizes the potential of that money. So these are the reasons why some of us would do this. Cheryl says, does age make a difference to get? Thank you for asking that question, Cheryl. We're going to show some examples of clients that are little babies, folks in their 30s and 40s. We have clients in their 60s and 70s. So age is a consideration if you're going to get insurance on yourself. But I would also remind you, there's a possibility to insure others that you want to protect. So it's not a limitation, just a consideration. Yes, ma'am. Thank you for asking that. We'll touch on that in a second. So we're going to be showing a policy from Mr. Kyle Fuller, my brother. I call him my genetically modified brother, taller and stronger than me. But this gentleman had the wisdom to create a policy, 10, 12 years ago. And what you see here is what it's called an enforced illustration. This enforced illustration is a current snapshot of where the policy is. And you'll notice here that this policy is now showing us year 11, 12, 13. If you've never seen an illustration or a piece of paper and there's a lot of numbers here, I understand it's very overwhelming. So I'm going to make this easier for you to create the interpretation. I also want you to, again, ask the person that invited you here and ask for the piece of content that teaches you how to read illustrations, by the way, if you've never gone through that. So Kyle is going to year 13 in this policy. And the way he's thinking about the savings environment is the following. In year 13, will put $8,000 in premiums in this contract. And his cash value, or the current equity inside this contract, will grow from $119,000 to $132,000 or $13,000. That growth is net of fees, is net of taxes, is completely private. So the way Kyle will think about this is, wow, in this year, if I put 8 and 13 come out by the end of the year, for every dollar in premium I pay, my policy is producing $1.63. Net of fees and taxes. This would be leaving $100,000 a chase, and at the end of the year, having $163,000 net of fees and taxes. I don't think Jamie Dimon is handing that kind of deal right now. Okay. Very efficient place to store money. And everyone, I can tell you, wants a 10-year-old policy, a 12-year-old policy like this. If you keep rolling down the timeline, the next 15 years, and you go to year 27 and 28, Kyle will do the same observation. I put $8,000 in premium, and my cash values go from $388,000 to $413,000, or more than $24,000. For every dollar of premium he pays in year 28, he's going to get $3.10 net of fees and taxes, completely private. Not only is a very efficient vehicle, it's getting more efficient by the year. That's the point of compounding money. That's the point of that wealth creator behavior and money. We take it 15 years further because this gentleman is only 30 something, right? So he has this runway, and the realization is that he's going to need money in his 30s, in his 40s, in his 50s, in his 60s. By the time he's 43, you'll notice here that the premiums even drop to a minimum. Quick parenthesis here, in a life insurance policy, we have a range of premiums from minimum to a maximum, and that flexibility is really important to do this responsibly and to be able to deal with future uncertainty. If you've never had that conversation, we are the right team for you, I promise you that. But by the time this policy gets to year 43, Kyle will be almost 70 years old. And by the time he puts this $2,600 in premium, the policy will produce 36, or per dollar of premium, there's going to be $13 of cash value growth in that year, net of fees and taxes. This is why we talk about thinking long term. This is why we talk about a savings environment that has efficiency that is unmatched. This is why banks are the largest buyers of this asset. This is why wealth funds have family offices. Wealthy individuals use this to store capital to protect their liquidity and to protect their people, themselves, their family, their business partners. So really, really amazing to watch live, real case, life insurance policy. By the way, this is not a life insurance policy that has, $100,000 of premiums a year. The minimum on this policy is $2,600, and then Kyle can put up to $8,000 every year. That is something that, $200, $250, all of us within our savings are blessed enough to have incomes in America that allows us to start a vehicle like this. And by the way, Kyle tells the story when he shares this, that this is the catalyst for a big portfolio of policies, over 20 policies protecting his family. It's not just one, right? And that capacity grew from understanding the value of putting money in here over time. I'm gonna take it a step further, because what we just discussed is the first part of the conversation. What are the reasons for any of us to consider storing some of our liquidity and our cash in a life insurance contract? Now, the use case is most people in America, and if this is you, I'd love to hear your thoughts in the chat, but when people hear life insurance, the way they think about this is death insurance. They buy a piece of paper, they'll put it in a drawer next to the batteries in the kitchen, and they will only read that piece of paper if somebody gets sick or somebody dies. We buy death benefit contracts, right? The moment you realize this is called life insurance and that there are living benefits that we've been talking about and that is a great place to store money, I hope all of you, if you own one of these things, pulls it up and reads it. If you don't know how to read it, I can tell you our team will be happy to do a review of the life insurance contracts you own for free. We would love to just make you aware of what you own and if you're maximizing the benefits of that contract. But once you realize that there's living benefits, the reasons to own this go from, do I need life insurance, to do I want life insurance? And I want tons of life insurance. I can tell you that with certainty. Because here in this example, Kyle starts this policy at 25. 5 years later, after COVID, he's a 30-year-old, and him and his wife have the opportunity to buy a $335,000 property here in Phoenix, Arizona. After COVID, I don't know if you're aware, but the real estate market in Phoenix at least took off and it became crazy. And before that move, Kyle had the opportunity to buy this because he had liquidity. He had been saving those $8,000 a year and he had been putting it in life insurance. So he had $60,000 in cash value. And to buy this property, the mortgage lender was saying, hey, you need a $17,000 payment to buy that private residence. So what did Kyle do? Kyle is going to go to the insurance company and say, I'd like to borrow your money, life insurance company, your general fund money, against my life insurance policy. I want you to put a lien on the cash values of my policy for the first $17,000. $17,000 out of the $60,000 I have there. And I want you to send me a check for $17,000 so I can go pay the down payment and buy this property. The insurance company would say, absolutely, you have a guarantee line of credit with us. All that we ask is that you pay the 5% interest because we were going to buy an investment, piece of real estate or a corporate bond. We were going to earn 5%, and all we ask is that you replace what we were going to earn. You become the investment. By the way, you control the terms of this loan. It's a non-structural loan. We'll talk more about that in a second. Kyle happily did that. And then 2 years later, the market went bananas. And he decided that he was going to lock the profits of that appreciation. And he sold this home with a net profit of $200,000. No capital gains on that primary residence. He brings that money back home, pays the $17,000 in principal, plus the 5% interest to the insurance company. They release that lien, and now the full $60,000 or more are available to him. And guess where he puts the extra money that he earned in that profit from that investment? He's going to send that money to his policy because he's understood that what he does here is keep growing that wheel. That line of credit, that equity in that contract is only bad because it's $60,000 and not $600,000 or $6 million. He wants to create that capacity to continue to finance things over time. I'm going to go here to a summary, but I just want to make sure. What year are we able to borrow from this policy? Bethany, thank you for asking the question. A properly designed policy, if you want to create liquidity, you can have access to that liquidity within a month of creating this policy. So the misconception is that people think they need to wait 2, 3, 4, 5 years to be able to access some of their cash value. The reality is that you should be in a position to access cash value within a month when we properly structure that. But obviously, we need to have an individual conversation with you to understand your needs, to understand how you could accomplish that. But most of these policies will allow you to access your cash values within 30 days of starting a policy. Yes, ma'am. Thank you for asking the question. And I see Josh, you had some responses, so thank you so much. So let me summarize here really quickly. We're going to go option one. What would have been Kyle's path if he just stayed with a bank option, keeping the money for 5 years on a bank? And we're going to do it in the when he bought the property and when he sold the property. So if he would have chosen the bank option, in 2020, he purchased the asset. So he would have pulled money from his bank account at $17,000. And then he would have likely earned 0.01% because banks were paying no interest. We had extremely low interest rates for that period of time. And the interest cost at age 90, the opportunity cost of paying cash and not earning interest, if you do the calculation for $17,000 at 4%, 60-something years, is around $180,000. One-time financial decision of $17,000 can cost him $180,000. That's just one time, okay? If he thinks about what happened with his option two, same down payment, same decision, same purchase, but now the long-term rate of return on the policy is at 4%. That's why you hear 3 to 4%. The reason you hear that is because policies in the long term will have a net rate of return of 3 to 4%. That's net of fees and taxes. That's not gross. So make sure you think about that properly. If you account for taxes, if you account for fee and you compare it to a high yield savings account or a treasury, that looks more like a 5, 6, 7, 8%, depending on your tax rates. So he has the ability to put interest to that money. And if he does it also until age 90, he's not going to have that opportunity cost. He's going to capture that $180,000 in interest. And what it cost him was the interest on the policy loan for those 2 years for $2,000. Right? So that's the acquisition cost of that property, just putting the money in a vehicle like life insurance versus just keeping it in a bank. What happens when he sells the property and he now captures the profit of an investment? Well, that $200,000 netting profit could have gone back to the bank, and maybe this time he finds a treasury. The long-term treasury earnings for the last 60 years has been 2.6%. Okay, if you do 2.6% for that $200,000 at 60 years or so, or 70 years, 60 years, correct? At age 30 to 90, yep, it will be $935,000. If you put that inside a life insurance policy and you have a strong competitive yield and you don't have taxation in that growth, the rate of growth here becomes $2.1 million. So his wealth plan grew by one financial decision of $17,000 to make a down payment on a home, but $1.3 million compared to what would have been if he chose a bank. This, folks, is happening to all of us when we do a vacation, when we purchase a vehicle, when we pay for college, when we buy an investment, when we buy a business, because it is what Nelson is talking about. It is the problem we've defined here. We finance everything in life, and we need to be thinking about financing things through the proper avenues to avoid the opportunity cost. So hopefully this little example sticks with you and makes you consider, hey, I should probably review how this would apply to me, because I continue to make financial decisions and purchases either with cash or credit that may be costing me more than I considered before. I'm gonna admit Logan here. So let me recap a couple of things. Life insurance, not an investment. Hopefully you live this and you think I'm crazy and you think I'm wrong. At least you know for sure life insurance is not an investment. So when you hear somebody in TikTok or your neighbor saying, oh, life insurance is the worst investment in all time, I hope what you bladder back is, sorry, not an investment. I don't think you know what you're talking about. It is not an investment. As a matter of fact, the way we position this for a lot of our clients is the following. We address issues like, hey, how could we use this life insurance policy as our foundation to deal with unpredictable income? If you're an individual in this call like us that has variable income, maybe you're a sales individual or you have commissions or you have seasonal work, the ability to have liquidity to float yourself through variable or volatile income is really important. Okay. Another thing that you may be dealing with is excessive spending. Do you need some help keeping your spending in control by reducing the amount of interest you're paying in some of these expenses, or just by becoming aware on how to create that relationship where you have a little more visibility into what you're buying? If Amazon is an enemy in your life, I encourage you to think about what are you doing from a flow of money intentional management by having the right place to store liquidity and protect it. The other thing, reliance on credit. If you are a business owner in this call and you think your HELOC or your line of credit at a bank or non-secured line of credit is your source of liquidity and is what's going to protect you, I highly encourage you to review what happened to lines of credit in 2008, in 2020, and previous recessions, and previous changes in cycles, in changes in interest rates, because relying on credit is great optionality. But if that's the only place where you can access liquidity when you most need it, you might have a tough lesson in front of you. So I highly encourage you to go and create, through life insurance, a guaranteed line of credit that is unstructured, that can truly protect your business and your family. That is true whether you're a business owner or just an individual, a family leader. We have a significant problem with credit in our country. So I think that's one of the principles we address here. Lack of liquidity. If you're going to bed and you put your head on a pillow and all you can think about is money and you're counting dollars versus sheep, this should be a really good question for you. Do I have enough liquidity in my life to have peace of mind, to know that everything can be okay, that nothing can hurt me in the next 6 months, year? It's another important thing. And finally, our retirement uncertainty. A vehicle that's getting that efficient, when you put $1 and $1.80, $3 or more are created, starts to become an opportunity where you can use this asset to support and supplement your future retirement income or future needs for income, because it's a really strong asset where the premiums you pay through a lifetime are going to be exceeded by the cash value or the equity of this contract. And at some point, you can use that equity to then create income, passive income for your family. If you want to know more about that, we have many people on this call that are specialists in that conversation. We'll be happy to help you and do some planning around how can life insurance help you stabilize your retirement income. So I'll give you one more piece of context, because I think this adds to the credibility of this conversation. People ask us all the time, okay, how come have I never heard of this? How come have I not really seen or met any of my neighbors or my family using life insurance like you say, David, having multiple contracts and putting tons of money in there and using it as a way to source funding for investments? I'll tell you, a lot of us need to ask ourselves a question. Have I ever looked into this at a deeper level? If you go to websites like the FDIC, you can go and read about how Bank of America, Wells Fargo, Chase, Citi, I call these guys the four amigos. They have significant amounts of life insurance cash values purchased on their top executives to protect their lives and also to accumulate capital. The Federal Reserve Bank is telling these banks that money stored in life insurance is as safe as money in their vault, as treasuries. They call it tier one capital, and they can measure their risky assets against this. Banks are doing this, and many, many other wealthy individuals are doing this. And the way they describe the benefits they get out of this is the description that I've been using. These benefits that you're about to see here are not David or Factum making these names up. This comes directly from the bank saying, the reason we buy significant amounts of life insurance is because this contract comes with guarantees. There's no assets that us as banks sell that say the word guarantee. We don't want to guarantee anything. We don't want that transfer of risk. But in life insurance companies are saying, we guarantee that when you die, not if you die, we'll pay a death benefit, we'll keep your cash values growing and your premiums the same. And that gives birth to everything you see around it. The ability to compound money daily, to have liquidity, to borrow from a guarantee line of credit in this flexible loan provision with a loan that you control the amortization for. Very powerful, completely private. None of you could find how anyone in this call, how much insurance they own, how many policy loans they have, who they own insurance on. So very private asset. This might be important if you have a child about to go to college and you're submitting a FAFSA application and you don't want them to see how much liquidity you're holding in a bank, for example. This may be important if you're dealing with a business that is potentially going to receive a lawsuit, or if you have exposure to creditors. Very important benefit. In addition to that, it's growing monthly. It has a very competitive yield, 3 to 4% net, like I mentioned earlier. And yes, it has that death benefit that is part of your legacy and a very important part of the whole piece. But I want to remind you, this is called life insurance because it has living benefits. It's not called death insurance. Very important realization. Cheryl, you were asking me about this. Age, who do we serve? I'm going to give you a synopsis here of different people that we help in our business because I think this is going to be useful for all of us that have questions like, am I too old to do this? Am I too young to do this? Do I have enough money to do this? Do I have, too big premiums, too little premiums? Do I need death benefits? So I'll show you a couple of examples here. At the top, you have a 6-year-old. A parent is buying insurance on their child. By the way, this is me. I'm buying insurance on my kids when they turn 3 weeks old. When they're 3 weeks old, I want a passport, a social security number, and a life insurance policy for the most amount that the life insurance company will sell me. Not because I want to buy insurance on my kids because they're going to die. Because in my kids, I see 90 years of compounding of money. So I want to give them that opportunity as soon as possible. Okay. This 6-year-old, $1,500 minimum, $3,000 scheduled in premium every year. Remember, I told you there's a range, and you all need to figure out what that range should look like for all of you. A minimum that's comfortable with the ability to overfund every year if you choose to. The 6-year-old has been doing this for 6 years, so they have total cash values of $23,000. The policy is growing $131 a month net of fees and taxes, and there's a death benefit associated to that. Somebody that's 25-year-old, a student, or maybe somebody new to the workforce, is just using this as a savings vehicle. Instead of a parent owning, I'm going to buy it because I want to start putting $4,000 a year with a minimum of 15. I'm going to save this cash value until the opportunity shows up to invest or to finance the next thing. And you'll notice here, the age only makes a difference, Cheryl, for the same or similar premium, that a 25-year-old being older has less death benefit for the same amount of premium than a 6-year-old. But the premium and the cash value accumulation behavior is the same. Okay, so policies that I have on my kids, on me, on my dad, the money that I put in there, the premium that I put in there to overfund and create cash value is fungible. It doesn't matter if it's on my 68-year-old father or my 4-year-old son. We have a 35-year-old here. He's putting a little more premiums. This is actually Kyle's policy that we were looking at it, $8,000 a year with a minimum of $2,600. At the time, he had $87,000 in this policy with a death benefit growing 480 months. If you're a real estate investor and you see $480 of growth on a monthly basis net, I would ask you to consider how many of your properties are performing at this level right now. It's really interesting to think. And again, I'm not calling it an investment. I'm just saying very efficient place to store money. Couple other examples, Cheryl. A 66-year-old is putting in between $5,000 and $10,000 a year, has cash value, has no desire to take loans, no desire to use the cash value. This individual is doing this because she wants to create a death benefit that would pay for state taxes that she needs to cover to protect a property that she wants to keep as legacy for generations in her family. Very different use. So she's using this for estate planning purposes. The premium, the cash value accumulation behaves the same on a 66-year-old. And then there's two individuals here at 36. One is an investor. They overfunded the policy up front. They have a significant amount of cash value accumulated in a short amount of in short term. This is one of my clients. They have $4 million because what they want to do is, if God forbid something happens to them, he wants his wife to be able to pay all the mortgages and all the properties he owns, to have no debt and skyrocket her cash flow so she's protected. So he's doing a combination of using the cash value to finance more investments and to have some protection. And then there's some other individuals that are incredible entrepreneurs, and they have not just one, but a portfolio of policies insuring keyman insurance and business partners, significant amount of premiums, significant protection. They use these lines of credit to do things that likely they would have to ask permission to bank for. If you want to go and produce a movie, how many banks do you think are going to hand you a couple $1 million to go produce that movie? The underwriting in some of these projects will likely lead to a no. But if you have a guaranteed line of credit you control, you don't have to ask for permission. So really powerful for people that are doing business or entrepreneurs that want to have significant access to cash. Benefits, I will remind you, are not a trade-off. If I borrow against my cash values, the money continues to compound. I have still a death benefit, and I have the ability to go financing life. We're not trading benefits. We're maximizing the benefits in our money. So that concludes the toughest asset. I'm sure you have many, many questions. I'd love to put them in the chat, and I'll also love for you to include them in your conversation with the person that invited you here. I'm going to quickly run through this. The last idea, the reassuring line, I told you. The prerequisite to doing things like this is to get very clear about your relationship with money. So just to leave you with a couple of thoughts, I would leave you with this experiment. Think about the amount of money you've earned in the last 10 years. So if you make $100,000 a year, in the last 10 years, $1 million have moved through your family, okay? The question I have for all of you is, out of all the money you've earned, how much money do you have access and control today? Okay, we ask this question in every room we teach across the country, and I'll tell you the answer that we get most commonly, 5%. If you've made $1 million in the last 10 years, most people have $50,000 or less of that money available to them right now. Because of all the things we've been talking about, the money sent out and away from them, they don't control the banking function, and they have not thought about the fact that you finance everything in life. This is a very important thought. So this has been happening and will continue to happen unless we change the way we interact with money. The curriculum you see here in front of us, this is the cover page of our Tough Money Workbook. If you want to have conversations with someone around your saving strategy, your liquidity strategy, what your freedom number would look like, if you know what that is, if you have significant amounts of debt or debt that you would like to get rid of so you reduce your debt to income ratio, if you want to have a financial management conversation, many of us in this call, all wealth strategies at Factum, have the tools to help you have this conversation with your family, with your team, with yourself individually. Because may not be your case, but if you go and think back to that average American we've been discussing, we have the following 3 pieces of a recipe to what we call weak money. We have incredible amounts of income. I'm going to just flash this quickly. To be a part of the top 10% of income earners in the country, your household income needs to be $178,000. It's incredible. More than 50% of the country, half of families, 190 million households in America, make less than $50,000. And yet, when you look at what's happening around the world, you'll realize that in America, we are very blessed to have very uncommon incomes compared to the rest of the world. And yet, when you look at the savings rate for most Americans is less than 5%. This is data from December 2025. I can tell you it has not changed based on the latest print. And also, if you look at the amount of liquidity we hold, is very little. Average business in the country is holding less than 27 days of liquid assets. Less than 27 days. This is why during COVID, so many businesses had to close permanently. Their revenue stopped, their expenses didn't, and they didn't have a way to pay for those expenses. So The recipe for weak money, high income, but we don't think about keeping as much, or have low savings and we don't think about liquidity. And I'll put this thought in front of you. We call this the tough money effect. Events will continue to happen. A disability, a disease, a death, a recession, a depression, a loss of job, having a baby. All these things are just events in life. And having weak money or not tough money, it's the easy way to have a significant negative impact in your life. And the game here is, how do we develop tougher money? Proper savings, proper amount of liquidity. I'm not going to walk through all these questions, but I am going to leave you with this thought, and I want to stop here to I'll give you the opportunity to ask some questions. I want to make sure we haven't missed, but this is how we start that conversation with many folks. So if you want to have access to this, I will tell you, many of our agents can walk you through this conversation. Are you aware of how much money you should be earning through your investment cash flow or passive income? Are you aware how much money you need to be saving to create a passive income? Do you know how much money you should be holding in cash reserves to protect yourself or take advantage of opportunity? Are you maximizing the benefits in the place where you're storing that liquidity, and how is your money management? The answers to this question should be yes, if you are for sure of the answer. If you say no, then the question that I would have for you is, would you like to know for sure? With that, I'm going to stop here. I want to make sure we address any questions, any comments. If you want to unmute yourself, if you have a specific question, I promise you our library is very deep and there's a lot more content than this. But this hopefully gives you appreciation for a new topic, a new conversation that could be very impactful in your life. And it gives you questions that you can have a deeper conversation with the person that invited you to this call. So any questions that I missed for anyone that has been monitoring the chat here? I see Josh Rose always asks, how many benefits am I getting from putting my money in XYZ? Absolutely, Josh. You know, that trade-off of benefits is a conversation we don't have. Like, one of the questions, just to leave you with this, one of the questions that I ask everyone is like, hey, what's the total, what is the minimum standard of earning you want in your savings environment? If I were to tell you what's the minimum interest rate that you'd be willing to put money in a bank to earn for leaving the money there, what would it be? And most people don't have an answer because we typically don't ask those questions. So we need to be thinking about, is it liquid? Is it safe? Is it private? Is it protected against inflation? Is it giving me a decent yield? And I can tell you, the moment you go down that road of benefits, there's going to be no competition to life insurance, because it is the place that has the most benefits in one single place to store your liquidity. No questions. Thank you, Josh. Any other questions
Hey,
down here?
David,
Yes, sir.
Yolande had a good question. She mentioned 3 to 4%, but paying 5% to borrow funds. Can you explain how that strategy is beneficial?
Thank you, Jolanda, for your question. I also see here, you can also be the banker and use self-directed IRA. What are your thoughts? What is the difference between the two? I love that question, Yolanda. I'm going to bring you over here. Sorry, I'm going to go back to the path of money because I think this will be very helpful. Okay. So in our framework, if you have a self-directed IRA, particularly if it's a Roth self-directed IRA, I would say wonderful. But I would define those as an investment vehicle to hold investments. So I would put that asset in my yellow box. The difference between green and yellow is very simple. Where is the line for zero risk? My bank account, my life insurance policies, my treasuries have zero risk. There's no morning where I wake up and those things are rolling back. In a self-directed IRA or a self-directed Roth IRA, there's a possibility of holding assets that represent risk because they're an investment. We're seeking a higher return and we're assuming some risk. I'm sure that you're managing that risk, but that will be the difference. So absolutely. You can use some of these vehicles to be the banker, to provide liquidity to borrow against. But just remember that the moment you start looking into the terms and the qualifications and all the requirements to manage that properly, you realize somebody else is the banker because they control the terms for those loans. Just think about all the compliance aspects of borrowing money and using money from a self-directed IRA. When we use a policy loan from a life insurance company, we're borrowing from a foundational asset that I am in full control. So when I ask a policy loan from a life insurance company, they're asking me two questions. Where do I want the money deposited and how much I want? And it can be up to 100% of what I own in that contract or my cash values. So the control aspect of an asset like life insurance is very different than a qualified plan that has a lot more involvement regulation from the government. Those things can change. In a life insurance company, in a life insurance contract, that is not the case, number one. How could it be beneficial to borrow having to pay an interest? Well, if you think about it, how is that interest determined? The insurance company was likely going to make an investment buying a corporate bond, and all we're doing is replacing that interest that they were going to earn at 5%. Why would somebody like Paul, since he read that, or me, be willing to pay that interest to the insurance company? Well, number one, I love the idea of leaving my money in a contract that compounds daily and not interrupting that cost. Number one. And number two, if I want to access liquidity, I can borrow the money from the insurance company, replace their yield, and go and create an opportunity that gives me a spread. The only reason to borrow money at 5%, Yolanda, is because I can create a 6, 7, 8, 9, 10% and create a spread. We're behaving like a bank. We're taking cost of money and lending it at a higher interest rate so we can create a profit. And now our money's behaving like a business. By the way, when I pay that 5% to the insurance company, the interest payment goes to the insurance company. But when an insurance company that's mutual creates a profit, what happens to that profit? That surplus gets distributed to the owners of the company, the policyholders, in the form of dividends. Those dividends, properly used, are tax-free, and they buy more cash value and more death benefit, and I continue to grow my access to capital. So there's a deeper conversation there, but I think it's a matter of doing a little more education and seeing some examples on how some of us are buying real estate, some of us are buying vehicles, some of us are issuing loans from a private contract where we hold our liquidity. So thank you for that question, Yolanda. I hope that starts at least the path of answering that question. I know I'm 5 minutes past, but I'll stay as long as you need me. If you want me to answer questions, if you have to run, I totally understand. I appreciate you being here. Cheryl, let's see. What about high credit card debt and wanting to have investments and have no idea where to start? Also, with a 91, I have a 91 living with you. It's a really good question, Cheryl. I'll give you a couple of thoughts here. People don't think about this often, but if you have credit card debt at 29, 30%, or 20%, whatever it is, paying a credit card at 29% is equivalent to getting a 29% rate of return on an investment, but it is risk-free, no risk. So when folks are trying to order their flow of money and their path of money and their frameworks on how to invest, we have a criteria for investment. We talk about when should we start investing? We need to have the certain amount of liquidity. What are we investing in? Cash flow and assets, right? We have a criteria we can help you with, but if you have significant amounts of debt, and you're paying 20, 30% really high interest rates, before you go and pursue an investment at 8, 10, 12%, right? I would highly encourage you to consider that paying this debt off is risk-free and it has a much more powerful rate of return that you control. So typically, and again, this is generic advice, which we don't give. It needs to be curated for you. We would go and help you say, hey, from the assets you have, is there a way to reposition these assets to pay that debt off or to start saving more to pay that debt off? And as we pay that off, the cash flow that we collect attacks that debt, extinguish it faster, and then when we're in a position to have that debt gone and some liquidity, then we can look at some opportunities to go invest that money. So there's a sequence to it that we would follow, and we'd be happy to help you, especially if you have considerations for other. I think what you're saying is maybe you have a 91-year-old living with you. So I think there's some extra considerations we should have in a private conversation, but something to educate yourself and consider to see if it matches your needs, by the way. Do not allow me or anyone to tell you this is for you. This should be a decision you make from a place of confidence because of your understanding. And we'll be happy to help you with that understanding. So thank you, Cheryl. Okay. Any other questions? Any other thoughts here? I think we still have some folks in the call. Milad, thank you for being here, brother. I appreciate you having your camera on, and I hope I'm pronouncing your name correctly. But if you have any questions, please. Thank you so much. Really appreciate you. Anyone else? Nope. Okay. Well, I'll leave you with one final thought. I highly encourage you to please have a conversation with whoever invited you. I promise you they have more value and more content that you realize for you to deepen your thinking, for you to learn some of this strategies at a deeper level. And if you have anyone else that would benefit from seeing this content, I'm going to encourage you. We do this webinar once a month for new members of our community, our foundation's content. It will be repeated in March. It will be again here in April. So bring them along, bring them with you. And if you want to see a more advanced conversation on some of our other content on a monthly basis, we have our Factum webinar. We'll be doing that one in 2 weeks. And I think it's going to be an example of an investment strategy using life insurance. So if you want to participate in that, please register for that event. With that, we want to wish you